Hi guys, welcome to today's video. In today's video, we are going to talk about the Silicon Valley Bank crisis and what we can learn from it. This video is going to be in two parts. In part 1, we are going to talk about what happened to Silicon Valley Bank. And in part 2, I'm going to tell you that what we can learn from the Silicon Valley Bank crisis. So let's begin. The Silicon Valley Bank started in the year 1983 and it was considered 16th most largest bank in US. Well, talking about Silicon Valley Bank, it was specialized in financing and funding the startups, especially tech companies. SVB was the favorite bank of all the startups. That's because it supported all the startups whereas other banks did not because of the risks involved in many of the startups. As we all know that banks have a lot of money which comes in the form of the current deposits, the saving deposits, the fixed deposits and the recurring deposits of all its customers. Now what the bank does with this money? They lend it out to people at a higher interest rate because they have to do so. If the bank promises you a 7% return on your FD, then the bank has to lend that money which is with the bank to someone who is giving them more than 7%. Then only they will be able to give you 7% return and run the show. This is how most of the banks function in this world. Now, let's understand what happened to SVB. Well, it was the time of COVID. The world was under lockdown and there was a technology boom. That means people started using digital services and high-tech gadgets. Well, because of the technological boom, all the IT industries got a lot of cash and a lot of money. As SVB was the favorite place of IT industries, so they started parking their money in SVB. And from year 2019 to the first quarter of 2022, SVB's reserves grew 3 times to almost $198 billion. During this period, the industry's deposit rate was almost 37%. However, during this period, there were no borrowers from the bank, so the interest rate diminished quite drastically. Now, SVB had a lot of cash reserve, but they could not keep this money idle. So what they did was 15% of the cash reserves they lent it out to people, and 85% of the cash they invested into different security portfolios. So SVB started investing its funds in two kind of bonds, that is AFS bond and HTM bond. AFS stands for available for sale and HTM stands for hold to maturity. Now let me tell you what is the difference between AFS and HTM. Well, in AFS, you are entitled to sell off your bonds anytime in the market, provided you sell it at the current rate of the bonds. And in HTM, you need to hold to maturity the money invested. So, you need not be worried about the volatility of the market. Now the story continues that the SVB was surplus in cash and it had invested 85% of the cash into bonds. Now started the real problem of SVB. As inflation started increasing in US and other parts of the globe, the interest rate of the banks increased quite high. Now, as they increase the interest rate of the bank to curb the inflation, because the prices of the bonds are inversely proportional to the bank interest rates. So, the value of the bonds decreased. And then SVB didn't know what to do. That was because without diversifying the portfolio, without analyzing what would be the immediate need of the bank, SVB had invested all the cash reserves into long-term bonds, due to which the unrealized losses of the bank increased quite a lot, from 0 in 2020 to $16 billion in September 2022. The fall in the value was so much that SVB or Silicon Valley Bank was technically insolvent by September 2022. To tackle this problem, when Silicon Valley Bank announced $1.75 billion of capital raise on March 6th, people became alarmed. There was a panic among the people and they started withdrawing money from this bank in sweeps. Now, if the bank had to return money to its depositors, it had to sell its bonds at a losses. Just because of the rate of interest had gone high and the cost or the price of the bonds had gone too low, they had to sell at a very huge loss. So finally, California regulators had to shut down SVB and place it under FDIC. Now comes an important question. That we as individuals, what are the financial learnings that we can take away from this Silicon Valley Bank crisis? The first learning: banks are run by humans. We need to acknowledge this fact that banks are run by humans, are managed by humans, so human errors will always occur. It is most likely that the mistakes will be made. The reasons for the failure may vary, but we cannot avoid the crisis totally. Well, there have been so many banking crises in the history of the world, and many have happened in our own country, like the case of PMC. So we need to understand one thing, that regardless of the restrictions, there are going to be many banking failures or banking crises in the future too. That's a harsh reality. The second learning that we can take home is our deposits are not safe. In our country, the government only guarantees an insurance of up to 5 lakh for any kind of bank deposit money if the bank falls under a crisis. No matter how much cash you have in your account, the amount of money that will be insured will be only 5 lakhs. So then you may ask me a question, what can be done about it actually? Nothing can be done about it. That's the truth. One thing that I can suggest you is that if you believe in putting FDs and having RDs in banks, post office schemes are a better option. That's because post office investment products have sovereign guarantees to some extent. The third financial learning is diversification is the mantra. Well, the most prominent reason for the crisis of SVB was its inability to diversify and its concentration into one kind of investment. Well, concentrated investments are always risky. So we as individuals, we should be able to diversify our investment into as many investment vehicles as possible. Well, if you ask me, I would suggest to you that your investment should go into equities, into bonds, into PPF, into gold, that is sovereign gold, into real estate. And if you people are investing into any other kind of investment vehicle, please feel free to comment below because, as they always say, never store your eggs in one basket. The fourth financial learning is risk cannot be avoided. If I ask you people, can you guarantee me one risk-free investment strategy? Most of us will fail to do so because there is nothing called risk-free investment. There is risk in everything or every investment vehicle that you are investing in. Like stocks and bonds, there is a risk. Real estate, there is a risk. Buying a gold, there is a risk. Cryptocurrencies, there is a greater risk. So what I believe is instead of focusing so much on avoiding risk, your whole focus should be on minimizing the risk. And the minimizing of the risk can be done only through hedging your portfolio and understanding your portfolio and understanding your investment vehicle properly and understanding the dynamics of the economy of the world, how it is changing. Keep yourself financially up to date. So that's the end of the video, guys. I hope you like this video. If you really like this video, give us a thumbs up, that is like our video, and spread it across your social media handles. That's because it will help us grow. A lot of effort goes into making these kind of videos. I hope you will appreciate our efforts. Thank you and God bless you.